Welcome back, ladies and gentlemen. My name is Joshua Castillo. If you've never seen the channel before, I'm a value investor. I really enjoy looking at different companies, and with everything, I'm learning the same way that you're learning, and I'm just hoping that I can kind of show you what I'm learning, what I'm looking into, and kind of just explain my own thought process. And these kinds of videos really help me work through all these different companies that I own. But really, Meta Platforms is one that has been on a complete downturn over the last year and a half, and it had a sudden uptick after the earnings call. So I'm really excited to go through this today. We're going to be looking at the Q4 and sort of the 10K earnings, as well as looking at the valuation model at the very end. So if you're interested in that, make sure to let me know down in the comments below. If you have any other companies you want me to look into, I'm going to be looking into a lot of semiconductor companies, but outside of that, if there's anything else, let me know as well. Without wasting too much time, let's dive right into it. So the first thing that I want to do, again, we have the iPad. So we're going to be taking a look at some of the different things that the CEO as well as the other executives have talked about from Meta Platforms, as well as just the numbers in general. So let's dive right into it. So Mark Zuckerberg said, next, I want to give some updates on our priority areas. Our priorities haven't changed since last year. The two major technological waves driving our roadmap are AI today and over the long term, the metaverse. Firstly, let's talk about our AI discovery engine. Facebook and Instagram are shifting from being organized solely around people and accounts you follow to increasingly showing more relevant content recommended by our AI systems. This covers every content format, which is something that makes our services unique. But we're especially focused on short-form videos since Reels is growing so quickly. I'm really proud of our progress here. Reels plays across Facebook and Instagram and has more than doubled over the last year. While the social component of people resharing Reels has grown even faster and has even more than doubled on apps in the last 6 months, the next bottleneck that we are focused on is continuing growing Reels and improving monetization efficiency, or the revenue that's generated per minute of Reels watched. Currently, the monetization efficiency of Reels is much less than feed, so the more that Reels grows, even though it adds engagement to the system overall, it takes some time away from the feed and will actually lose money. But people want to see more Reels though, and the key to unlocking that is improving our monetization efficiency so that we can show more Reels without losing increasing amounts of money. We're making progress here, and our monetization efficiency on Facebook has doubled in the past 6 months. In terms of revenue headwind, we're still on track to be roughly neutral by the end of this year or maybe early next year, and after that, we should be able to profitably grow Reels while keeping up with the demand that we see. In our broader ads business, we're continuing to invest into AI, and we're seeing our efforts pay off here. In the last quarter, advertisers saw 20% more conversions than the year before, and combined with a declining cost per acquisition, this resulted in higher returns on ad spend. We continue to be excited about monetization opportunity with business messaging too. Facebook and Instagram are two pillars of our business, and in the next few years, we bring messaging online as the next pillar. One way of doing this is to click to message ads, which is now a $10 billion run rate. So I just wanted to open up with that. That was something that Mark kind of laid out as far as the earnings call went, and just kind of setting the tone of everything, and really how this is a year of efficiency. It's a year of making sure that monetization stays where it's at as far as the ad platforms and things that they're doing, and actually what they're doing on the back end to make sure that people who run ads and actually use these platforms for their businesses are able to do so in an efficient manner, be able to use all the ad spend properly, and actually do well so in a good manner. Now, moving on to the earnings release, they go to say, our community continues to grow, and I'm pleased with the strong engagement across our apps. Facebook just reached a milestone of 2 billion daily actives, said Mark Zuckerberg, and the progress we're making on our AI discovery engine and Reels are major drivers of this. Beyond this, our management theme for 2023 is the year of efficiency, and we're focused on becoming a stronger and more nimble organization. Now, right out the gate, I'm just going to say, if you haven't already seen the news, there was a lot of people that got laid off. It was a lot of big headlines that happened. Obviously, Meta's not the only big tech company that's doing this, but that's why you see year of efficiency, a lot of reorganizations and restructuring happens. So that's why I want to go over a lot of this today. So you'll see that in the numbers, you'll see where they're losing and why they kind of had to end up laying people off and end up restructuring a lot of their organization. So looking at the Q4 and the full year 2022 financial highlights, you can see for the quarterly, which is the 3 months ended December 31st, as whereas the year ended. So year over year for the revenue on the quarter, it's down slightly, 4%. A lot of that has to do with the headwinds in the foreign exchange rate. Now, as far as the year as a whole, it's only down 1%, so not terrible. Obviously, you want it to keep growing, but not a crazy, not anything crazy that we didn't already expect, especially given the Forex, as well as losing a lot of the ads that we had in Europe because of the war. Now, moving down it, you can see that the net income and sort of that bottom line number actually decreased a lot, and it has to do with the way that cost and expenses increased at the top. So for the quarter, it's down 55%. For the whole year, it's down 41%, and this was really where it all came through, and a lot of it has to do with, again, they hired a ton of people in 2022 and in 2021, so it's not surprising that when you see a slight downturn that these companies are going to start making their organization a lot more lean. Apparently there was a lot of hierarchy within their company, and they're trying to make that a little bit more horizontal and less vertical as far as being able to get things done, actually having managers in place instead of having managers that manage managers that manage managers, and it keeps going up as you see in some other corporations. Now, other than that, you can see kind of on the right side, I'm going to indicate sort of, yellow is like a red is not so good, and green is, yeah, it's pretty good. So continuing on that though, you can see for the operational highlights and the financial highlights, so daily active people is up 5%, monthly active people up 4%, daily active users 4%, and monthly active users up 2%. So for ad impressions and price per ad, in the fourth quarter of 2022, ad impressions delivered across FOA increased by 23%, and the average price per ad decreased by 22%. For the full year 2022, ad impressions increased 18% year over year. The average price per ad decreased 16% year over year. Now, you're going to hear them talk about it if you look at any of their sort of guidance or anything like that, but a lot of that has to do with Reels is going to cannibalize a lot of what they have right now, and the way that they ramp is they basically go for impressions at the beginning and then they improve the monetization. That's kind of what I opened up with here, but you'll see that throughout this, and even before Sheryl Sandberg left, this was something that they were talking about where it's gonna take a minute for them to get this, but they did this with stories, they did this with a lot of other features on Instagram and Facebook, so we're gonna have to see this play out in Reels and see ultimately what profitability comes from this, because again, Reels is competing with TikTok and some of the other short form videos. Continuing on, again, revenue was down 4% and 1% year over year for the full year. Had foreign exchange rates remained constant with the same periods of 2021, revenue would have been $2.01 billion and $5.96 billion higher, an increase of 2% and 4% on a constant currency basis. The costs and expenses, so again, costs and expenses were up 23%. This included charges related to our restructuring efforts, so $4.2 billion and $4.61 billion for the full year 2022. So that's kind of going back to what I was talking about earlier. Their CapEx spend wasn't too crazy, $32 billion on the year. And I say that's not that crazy because, I mean, the amount of money that they earn, they need to put a lot of money into the CapEx as far as data centers and other financial obligations they have revolving around that. Share repurchases was pretty big this between this year and last year. Share repurchases have been pretty big. 6.91 billion on the quarter and then 27.93 billion on the year. As of December 31st, 2022, they had $10 billion worth of the original share repurchase authorization, so they still have $10 billion left. And actually, when they announced their earnings, they also announced a $40 billion increase to the share repurchases, bringing it to $50 billion in total, which honestly, that's a lot. That's quite a big amount of their capital, their market share right now. And obviously, they're going to be doing this between their free cash flow and maybe taking on a little bit more debt if they deem it necessary. They're going to continue to buy back stock. So we'll have to see how this actually plays out. They bought a lot of stock back when it was at 200, 250, 300, 330. They bought a lot of stock. So to see them do that, it's kind of a waste of money if they buy it when it's high, but we'll have to continue to see. A lot of the share repurchases are really just offsetting the SBC that we're seeing, so we're going to keep paying attention to that. Their cash equivalents and marketable securities, $40 billion. Their long-term debt, $9.92 billion. Their headcount, again, so their headcount was 86,000 people, and that was an increase 20% year over year. Again, pretty crazy. But the reported headcount includes a substantial majority of the 11,000 people that were impacted by the layoff. So come first quarter 2023, you won't see those numbers anymore. Now, going on with the restructuring, so during the quarter, they took several measures to pursue greater efficiency and to realign our business and strategic priorities. This includes facilities consolidation strategy to sublease, early terminate, or abandon several office buildings under the operating leases, a layoff of 11,000 employees across both segments, and a pivot towards a next generation data center design, including cancellation of multiple data center projects. So really quickly before I show you the numbers, they got rid of a lot of the offices. They're kind of going to take a little bit more of a remote work from home kind of situation first and let people kind of work in the offices if they really want to, as well as obviously layoff is a layoff. And then the data center projects, they actually extended the use of some of their data centers as well as cutting some of the big ones for now. Obviously they're investing still into AI and things like that, but I think that they were probably getting a little bit too ahead of themselves and probably not keeping equipment and just buying the next new thing. They actually extended the useful life of a lot of their equipment, so we'll have to see how that plays out in terms of generating leads and things like that through AI. So you can see the numbers here really quickly. I'm just going to pop it up. In total, you have $1 billion in facility consolidations, $975 million in severance, $1.3 billion in data center assets, and in total it's $4.2 billion in restructuring charges. They said that a lot of these are going to come, so 3.76 billion is going to go under FOA, 440 million is going to go under the Reality Lab section, and these excluding these charges, our operating margin would have been 13 percentage points higher, our effective tax rate would have been 1 percentage point lower, and our diluted EPS would have been $1.24 higher for the fourth quarter of 2022. So you can see that again, they included a lot of that restructuring to make sure that they got it in and fitted in 2022. I'm sure there's still going to be some lingering things, especially from the employee side of it. There's going to be still some lingering things that they didn't accrue in 2022 that you'll see in Q1 2023 and maybe through the rest of 2023. But a lot of the big charges and things that they accrued came in 2022. Now, as far as the outlook and what they're expecting, so we expect, this is from the CFO, we expect first quarter 2023 total revenue to be in the range of 26 to 28.5 billion. Our guidance assumes foreign currencies will approximately be a 2% headwind year over year. We anticipate a full year 2023 total expenses of 89 to 95 billion, which is lowered from 94 to 100 billion. Again, a lot of the restructuring things that I talked about impacted that pretty heavily. We now expect to record an estimated $1.1 billion charge in 2023 relating to the consolidating of our office facilities. This is down from the original estimate of $2 billion. And really, again, going on to the CapEx, we expect CapEx to be in the range of 30 to 33 billion, lowered from the prior estimate of 34 to 37 billion dollars. This reduced outlook reflects our updated plans for lower data center construction spend in 2023 as we shift to a new data center architecture that is more cost efficient and can support both AI and non-AI workloads. Substantially all of our CapEx continue to support FOA. So again, nothing too crazy to expect from 2023. I think it's going to be a year of trying to run lean, see what that actually looks like on their financials, and kind of work through that. So moving on though, you're going to see kind of the rest of their financials. We're going to go through the financial statements. So let's dive right into it. So as far as the net income goes, you can see that they had $116 billion for the whole 2022. And for 2021 is $117 billion. As far as net income goes, $23 billion, and then in 2021 it was $39 billion. So obviously a pretty substantial decrease on the bottom line, but as again, they kind of get rid of a lot of the people that they had, you'll see a lot of different changes to these different structures. And they actually pointed out in the bottom of this, the share-based compensation, and the share-based compensation will also go down with this. So you can see that's a pretty big increase to go from 9.1 billion in 2021 to pretty much 12 billion in 2022. So share-based compensation obviously still needs to be offset by the stock repurchases, but ultimately I would like share compensation to really go down. I don't want this to continue to increase because at the end of the day it dilutes me as a shareholder, and it's an expense. Whether or not it's a cash expense doesn't really matter. It's still an expense to the business that if they're repurchasing shares, it really is almost like they're spending money for no reason. Now again, really quickly, just so you can see the last 3 years. So these are kind of like the COVID times, and you can really see the margins that they had. So the bottom piece is the actual margin of each one. So what I really wanted to point out is if you take a look at the cost and expenses, the margin of revenue, and what actually, like 75% is what it was for 2022 versus 60% and 62% the prior years. And then you can see at the net income level, that really impacted the net income because you have a 20% net income margin for this year versus 33 and 34% last year. So you'll have to keep an eye out again as you work through these financials to decide, is this a company that's dropping its margin, or is this just kind of a blip and it'll continue right back up to 25, 30, 35, and it's kind of been bouncing in that range. So you'll have to continue to watch that. That is something that I think a lot of people may not pay attention to enough. Looking at the balance sheet, nothing too crazy to add. Obviously, they've been adding to their property and equipment from last year. Their cash and cash equivalents is pretty good. Their operating lease liabilities will probably come down slightly. It's obviously a little bit up from last year, but we'll have to see what that actually looks like. The long-term debt was something that they added fairly recently this year. So again, they're leveraging their balance sheet. So just have to keep an eye on that and see if they continue to do that, or if that's just going to be a one-time thing. They used a lot of that cash to make sure that they could do their repurchasing. Going on to the cash flow statement, nothing too crazy to harp about beyond just the share-based compensation and the actual calculation of the free cash flow. And I'll have something down below to actually show you the free cash flow, but just quick rough math. So take the net cash provided by operating activities, so $50 billion for 2022, you had $57 billion for 2021, and then just subtract out the PPE, and as well as there's some financial lease obligations that you'll see in the next slide. But really, again, share-based compensation being $12 billion is a pretty huge hit, as well as you can see some of the impairments that they had that I had mentioned earlier for the restructuring. Their purchasing of PPE, so really that $31 billion that they had this year versus $18 billion that they had last year. Again, it goes back to the data center and what they're actually trying to do. You can see also down below in the financing activities, they repurchased almost pretty much $28 billion worth of shares this year versus $44 billion last year. Again, I kind of wish those numbers were flipped because the stock was very expensive last year relative to this year. But, you can't get it perfect all the time, I understand that, but I really do think that it's important that they use this cash, if they're going to keep it, to buy back shares when they're cheap, not just because they're repurchasing shares because they're trying to please someone. So, but moving on to the segment information, and really what people I think care about a lot is how Reality Labs is doing, relatively speaking. So FOA, again, down very slightly. A lot of that has to do with Europe and just the overall downtrend in spend for this year. But Reality Labs also had a slight dip as well. So when you look at it, though, you really are paying attention to the total income from operations. So again, they made $42 billion in total for the operating income on FOA, and they lost $13 billion on Reality Labs. And one of the things that they keep saying over and over again is that they think that this is going to continue to lose, and they don't know exactly when it's going to become profitable. So when you're looking at this, you have to continue to watch. So last year it was $10 billion. This year it's $13 billion loss. Is this going to continue to increase, and is this just going to be a money pit? For now, it's looking like it's going to continue to be a money pit. And again, FOA is receiving the majority of the capex, is receiving a majority of what their focus is on as far as spend wise, but still $13 billion to be spending that kind of money and not recouping any of it. It's a long-term play from the company perspective, but you as the investor need to debate whether it's a realistic perspective for the company. Now, as far as the free cash flow goes, you can see the last 3 years here. So again, net cash provided by operating activities, so $50 billion this year, $57 billion last year, $38 billion the year before in 2020. So the free cash flow is $18 billion this year. Again, they spent a lot on capex and just different property that they needed, $38 billion last year and $23 billion in 2020. And then lastly, if you want to see what they actually did with their repurchasing, so how much they repurchased as far as shares go, a lot of the repurchasing was done in November for this last quarter. And they've also, again, added to the shares, added to the amount that they're allowing you to they're allowed to repurchase, so $50 billion, which is, again, a substantial amount of their market cap currently. Now, as far as revenue by geography goes, you can see here what actually each quarter looks like. And honestly, to see some sort of ticks up as far as Q4 goes, and it kind of still follow that trend, where it seems like Q1 is kind of where things start to go down a little bit. So I have to see when Q1 23 comes out, if it follows the old trend or if it, if it's going to stay all relatively flat. But I am excited to see that there is some more spend in Europe as well as Asia Pacific. Obviously, the rest of the world will end up catching up at some point, but to see really Europe have a good spend relative to Q3 2022 gives me a little bit more hope that I'm not too scared about what exactly is all going to happen. But one thing that they did note is our annual worldwide ARPU, which is average revenue per user in 2022, which represents the sum of quarterly ARPUs, was $39.63, a decrease of 3% from 2021. For 2022, ARPU decreased by 9% in Europe, 4% in the United States, and increased by 4% in Asia Pacific and 8% in the rest of the world. In addition, user growth was mostly in geographies with relatively low ARPU, such as Asia Pacific and the rest of the world. We expect that user growth in the future will primarily be concentrated in those regions where ARPU is relatively lower, such that the worldwide ARPU may decrease at a higher rate or increase at a slower rate relative to ARPU in a geographic region in any particular period, or potentially decrease if ARPU increases in each region. So again, their main kind of target is users as well as ARPU, so average revenue per that user, and really following that and making sure that you understand what they're actually trying to do with each piece is probably one of the most important things. And I think that Asia Pacific is really where you're going to see a lot of the growth come in, and obviously they need to become more efficient monetization wise and earn some more revenue per user from those specific areas. But I think as India and other regions within Asia Pacific actually come online and get on social media, you'll start to see more and more ad dollars for those regions get spent there. So it's really, again, it all comes down to where is the ads being spent. A lot of it's being spent in the United States, but as more people get smartphones and things like that, you'll see it in other regions as well. Now, I pulled this from the 10K. It's about Reality Labs, and I kind of want to just go over it really quickly because I think, again, it's important to understand kind of what it all looks like. So they said our total Reality Labs investments was $15.8 billion in 2022, including expenses relating to headcount, technology development across these efforts. As these are fundamentally new technologies that we expect will evolve as the metaverse ecosystem develops, many products for the metaverse may only be fully realized in the next decade. Although it is inherently difficult to predict when and how the metaverse ecosystem will develop, we expect our reality segment to continue to operate at a loss for the foreseeable future. Our ability to support metaverse efforts is dependent on generating sufficient profits from other areas of our business. We expect this will be a complex, evolving, and long-term initiative. We're investing now because we believe this is the next chapter of the internet and will unlock monetization opportunities for businesses, developers, creators, including around advertising, hardware, and digital goods. And they kind of went on to say, kind of talking on this, they have a whole section in there talking about kind of what to expect from Reality Labs and what products they have. And one of the things that they had talked about was, for example, in 2023, we expect to spend approximately 50% of our Reality Labs operating expenses on augmented reality initiatives, 40% on virtual reality initiatives, approximately 10% on social platforms and other initiatives. We apply significant judgment in estimating these expense breakdowns as there are certain shared costs across product lines, and our expectations are subject to change, including as the metaverse ecosystem and other business strategies evolve. In particular, we regularly evaluate our product roadmaps and make significant changes as our understanding of the technological challenges and market landscape and our product ideas and designs evolve. I think one of the craziest things, though, that I guess I didn't really pay attention to too much, and again, if you read like the rest of the section above it, you can kind of see what they're actually talking about as far as their products go. But they're actually spending quite a bit on augmented reality initiatives, which I think for them, that's the big thing, is how do I implement augmented reality? And you really saw that, I think, with phones when Pokemon Go first came out. That was kind of like people's first look at augmented reality, because it was really taking the environment around you and being able to play a game in that environment, and that was catching Pokemons at the time. But it was really now, it's how do we kind of integrate different things like the Ray-Ban glasses or the Google Glass or things like that. How do we integrate that into our day-to-day lives? And that's what part of this Reality Labs segment will end up doing. Now, as far as everything else, I don't have anything else that I wanted to point out quickly. Again, if you want to learn more about this company as a whole, make sure to go through the 10K, go through the earnings call, go through all the different filings that they have, and try to learn a little bit more. But going on to the valuation model and what I actually want to show you and what I think it's worth today, let's take a deep dive and actually look into this. So again, the way that I do my valuation models, it's on a 7-year period basis. You can see the top portion here. It's actually going to be things that came from their 10K. So current outstanding shares, current revenue, current estimated free cash flow, net income, and obviously you can mess with the revenue and everything else if you want to. I just like to kind of play around with this every once in a while. But really what matters is your inputs down below. So for the revenue growth on the low end, I think 2% is probably the worst case scenario. On the high end is 5%. Now 2% matters in terms of where does 2% start. And in my case here, it starts from the current revenue of $116 billion. In other cases, I've started it at $100 billion when I was estimating like really bad case scenario. So it all starts from where the revenue is starting from. So 2% growth from $116 billion is where we're going to be starting from. High end, 5%. Profit margins, 20% on the low end, 30% on the high end. Free cash flow margin, 18% on the low end, 30% on the high end. The terminal PE and price to free cash flow multiples were 14 on the low end and 20 on the high end. Discount rate of 12.5%. I like to use 12.5% as kind of like my starting point, depending on where the weighted average cost of capital is for a company. I may go higher or lower depending. But in this case, 12.5% gives me a good margin of safety built into that discount rate. But in case you want to see what I'm actually looking at, so the worst case scenario for both net income and free cash flow, as far as multiples and things like that go, is about $100. And it hit 80, 89, 85 a couple months ago. So not too crazy as far as a worst case scenario goes. It's obviously possible. And then obviously base case is $168 to $155 billion or $155. And then base case scenario is $236 to $236. Really what I want to pay attention to though is beyond that is just the actual probability table. So I like to take this, give kind of a probability of each scenario happening, and then it averages out. So the fair value I average right now is about $152. I think $152 to $160 is where I'm looking at as far as my average fair value and what I think it might be worth. Today it's selling at about, well, at least as of making this video, it's selling at $183 per share. So do I think that's significantly overvalued? Of course not. Again, value is going to continue to fluctuate up and down depending how the company is doing, and the stock price will go very high and very low depending on what people's emotions are doing. I'm focused on the fundamentals. I'm focused on what I'm actually going to do with this. My cost basis is I think like $230. Obviously, hindsight being what it is, I wish I would have bought back my position or bought my position and then sold off my old shares just so I could lower my cost basis, but I'm just holding these shares. If it gets significantly lower, again, the fundamentals remain. I'll probably add a little bit, but this is such a significant portion of my current portfolio that I don't want to keep doubling down as this keeps going down because I don't want to lose all of my money. So I've been looking for other opportunities and just holding this company at $233 per share. And I'm just going to continue to ride it out and see where this company goes, and I really like this one. Let me know down in the comments below if you own Meta or if you're interested in other companies. Let me know down there as well. Make sure to subscribe, hit the like button. Hope you have a great day and happy investing.